Hey everyone, welcome to Dr. Frank's Finance World. I am Dr. Frank, the bank, where I try to teach you something about finance and you can bank the results of that in the future. So if you like what you see, we've got about 20 videos up now. We'll have many more in the future. Please subscribe and hit notifications so you know when new ones go in. Look in the notes and links. We're building those through time, but you'll see more in there soon. And then check out the books. There's some pretty good books over this series of investments. And they're already in our bookstore on drfranksfinanceworld.com. And you can go directly there. If you're going to read something, it's probably a pretty good place to start. So big picture is finance is about processes. It really is. And I tell my students many times it's a three-step process, but ultimately in finance, we're trying to figure out what something is worth today. And to do that, we have to know some assumptions about flows along the way and the risk we're going to take to get there. And that whole process we've looked at before is for stocks is typically called DCF or discounted cash flow. You can go back to the fundamental analysis and look deeper into that if you wish, but you need to know what the risk you can accept or are willing to accept or sleep with is at night, and that will help define the returns that you're going to make. So we are going to go over something today called investment policy statement. You can see it over here, and basically that is tells you it's sort of a framework for what is happening and what you expect to happen and what your assumptions are, if you will. And the bottom line is it's a roadmap to getting what you want out of this investment process. Along the way, though, just keep in mind that the average risk return for the market out there is a return of about 10%. That's non-inflation adjusted over the last 70 years or so. And the standard deviation of that return has run somewhere between 18 and 20% on average. So the IPS we're going to look at in a second here, it starts with your goals and objectives, and that's important too. So you can see where it is you want to be and what's important to you. Importantly, it talks about strategies along the way. We don't get too deep into strategies. There's a lot of them later on, but how are you going to meet those objectives? What are you going to own stock? You're going to own mutual funds, you're going to own bonds, that kind of stuff. So asset allocation, of course, and then risk tolerance and your liquidity needs. At different points in your life, you're going to have a different need for liquidity. So let's check out the example. This is actually from the Student Managed Fund at Colorado State University. And it just talks about, this is the highlight, the setup for it. It's the goals and objectives and so forth. The risk tolerance you're willing to take, is that going to be 10% for you? I mean, what is that going to be? Are you going to be going something higher than 10, something lower than 10% as far as the returns and so forth? And then what tolerance do you have for risk? My father had none. I have quite a bit, but probably because I've been doing it for a long time. But at any rate, you'll find out like we did in 2022, that years that you have 10, 20, 30% down, people's perception of risk tolerance suddenly changes. But at any rate, just keep in mind what the market makes and what you think you would want to make. When you're young people, you generally take more risk because they have more of their life to make up the difference. They have that time asset on their side. Later on, you typically have the financial asset on your time, but not enough human capital time left to make the money back, and you tend to get more conservative. So it changes throughout our own life cycle. Some constraints. Maybe you need the money in 5 years. Maybe you don't. Maybe you don't need it for 50 years. But the longer you can go, the more you can put it into risky assets and typically end up on the positive part of the curve, because those occur frequently as well. Liquidity. Some people need some in cash, or they want to have it back for transactions or margin requirements if you get a little deeper into this. And so, for instance, the average mutual fund tends to have about 3 or 4% of their assets in cash to cover redemptions of people when they're coming back and looking for their money back and so forth. So anyway, if it's in a retirement fund or not a retirement fund, there could be some tax ramifications of that. If there's any legal or regulatory out there for the student fund at Colorado State University, they consider them socially responsible investing principles. They're not going to invest in companies that do alcohol or tobacco or firearms or gambling or that kind of stuff. For me personally, those are called sin stocks, and I always say sin is in. I'm more than willing to put those on my plate as far as investing, because you have some interesting correlations to other investments, but without the socially responsible stocks, or so I suppose socially irresponsible, you still have probably 7 or 8,000 to choose from. And of course, are you going to do it through stocks or through bonds or options or indexes? What's going to be your process out there to allocate these assets to? And finally, the fund there talks about no more than exposure a certain percent of its assets to any one non-diversified area and so forth. They are looking for to buy companies that are undervalued so they can hold them and they can get rid of them when they're overvalued and so forth. They don't tend to hold bonds in their portfolio since it's an equity portfolio, typically equity only. But you might in years later on, especially as interest rates have come up, they become a more interesting investment. So asset allocation really drives a lot of your returns because how much you're putting into stocks, how much you're putting into bonds or fixed income, and that makes a big difference. For instance, if you were going to put your money, if you're a non-risk taker and you put it into all money markets to make sure you don't lose any money, in the end, you're not going to make any either, or very little. And long term, the super safe stuff doesn't actually keep up with inflation. So you're not really building wealth. So you probably need to have some of each of these in there. And that will be based on your risk tolerance and how you choose to invest it in what stocks or mutual funds or ETF. It does raise the question, however, of market efficiency, which is something we're going to talk about up there. Does the market get it right, generally speaking, on a daily basis, or does it get it wrong? If you believe markets are efficient, you'll actually want to own indexes. S&P 500, NASDAQ. I joke with my students in class, literally there's more than 200 different indexes, so that doesn't narrow everything down, but basically sector funds and indexes specifically have a wide range of things that they might be investing in, and that might be something you would want to own and forget about. Let somebody else manage it, because if you think the markets are efficient, you can't beat them anyway. Why waste your time? If you think the markets are inefficient, you would want to hold individual securities or mutual funds. And then the next question, of course, is how much into each of those? I flew for a number of years in the Air Force, so I think of things from an airplane perspective a lot. And that's how I look at this part of it too. When you first are flying in the plane and you're sitting up there altitude, cruising along in the back there, you're looking at the big fields of green and little circles that the farmers have out there. That to me is sort of the 35,000 foot view of the economy. You got a big, big picture, but nothing is that much in focus. And that's where you're going to be doing your asset allocation out there. How much you're going to put into each, stocks or bonds or money markets, that kind of stuff. And if you want a great book for the macro view of the economy and what it means, this Martin Zweig, Winning on Wall Street, he was a PhD finance guy who came up with the put-call ratio in his dissertation, but he actually has, it's the first sort of practitioner quant book, if you will, that I ever saw, and I was pretty impressed by it. Some of the stuff is a little old in the sense that, prime rates and that kind of stuff are different than when he was going through it, but it's really interesting to see how he sees things fitting together. So as you're coming down and out of altitude, you get to the 5,000 foot level, you've asset allocated. The next question is where? If you're going to do stocks, what sectors are you going to put it into? Even bonds too as well. And to me, you look at a little more intense macro out there. What's happening in those specific areas you're thinking about, and how will they compete in that economy? How do you figure that out? Honestly, it's relative to historical and any benchmark. And the assumption there, of course, is that the historical data will repeat, therefore you might actually have some momentum, or that you'll have a regression to the mean. I say this is one of the most powerful forces in nature. That's why we don't have 20-foot human beings, for instance. But in the market, when stocks or sectors or mutual funds tend to outperform over a period of time, it's almost impossible to do that forever. And they tend to come back to a natural average, if you will, and that's called regression to the mean. We'll look at what research has to say about that as well. Continuing down, finally, you get to where you're in the traffic pattern. You now have looked at the economy. You can say, based on what sectors I want, what industries would I want to be in? Like you might like consumer defensive, given it's a little rougher economy right now in January of 23. And therefore, even within the consumer discretion or consumer defensive, what companies do you want? Do you want a Walmart, or do you want a drug company or something like that? Screening helps, which is where we're going to get to FinViz again. There's a FinViz link among the websites on drfranksfinanceworld.com. And anyway, you can go there and look at it, and as does recent historical performance. And the street level view, of course, is once you've looked at certain industries, what securities you're actually going to own. And that is getting to the nitty gritty. So what does their accounting say among different ones? That's called bottom-up analysis out there. What weights do you ultimately put into those? We're going to study that. It's a process called Markowitz. Is actually an Excel file that will help calculate that for you. And then, of course, the value at risk out there, which is another statistical method we'll take a quick look at as well to give you some sense for how much you could lose, at least historically. The strategy at each flight level there is the tough part. How are you going to go about it? How much are you going to put in each? But there is help in history and research out there. So the books I'm looking at this time is Winning on Wall Street, essay with Martin Zweig. One Up on Wall Street, great book by Peter Lynch, is also on the book list there. Let's take a look at what research has to say. These are the two research articles, and I'm just going to pop out of here and show you what those actually say. Stand by. Here we go. So one of them is asset allocation strategies, data snooping, and the 1/n rule. The 1/n rule essentially says if you have 4 securities, you put 1/4 of your money in each. If you have 10 securities, you put 1/10 of your money in each. Sort of a blind allocation strategy process. There is a sense that there tends to be some data snooping out there in the world where people will know what to expect and sort of pull that data, or they'll look at what the data says specifically and only invest in there. They say in our finance world, we're supposed to have an idea and not to look at what the data says. Actually, a lot of sciences out there, like research associated with the human body, they do a lot of data snooping and try to figure out what might be going on. But they do a bunch of it. They do out of sample performance. What happens is you test the sample to see what's going on, but you reserve part of the sample that when you see what's going on, you go to that reserved sample, the out of sample, and see how it performed and see if what was happening before continues to happen. Because then you can, in theory, take what happened among all of them and maybe it will do the same thing going forward. Lots of different strategies. 126, 2,000 extended strategies. We find some do outperform, but not very many. Once you account for data bias snooping, there are very, very few. Thus, our finding underscores the necessary control for data snooping and the fact that actually just taking your money and dividing it by the number of different assets you have out there is not such a horrible strategy. It's actually kind of tough to beat. Next, we talked about how regimes affect asset allocation. This is what I find interesting because when we do the Markowitz benchmarking stuff and the Excel file on that, it presumes, one, that history will repeat itself, but it also looks across a time period where you don't know whether it's an up or a down market. And the fact is, I tell my students it's kind of a bummer. We go calculate beta and say, hey, our stock or our fund or our investments act like this relative to the market itself. But actually what happens is that the most investments will have a different beta in an up versus a down market. I know, bummer, right? So when it's a down market, we've always said correlations, we try to buy things that don't necessarily move together. Correlations all start to center up around 1. In other words, everybody loses. And that's what they find here in international markets, characterized by episodes of high volatility and unusually high correlations, coinciding with bear markets. Boo! The correlation is 100%, but the return is negative. This article provides models of asset returns that match these patterns, illustrate how you use asset allocation. The presence of regimes with different correlations and expected returns is difficult to exploit. It's hard to figure out what's going on there. Nevertheless, for global all-equity portfolios, the regime switching strategy dominated by static strategies in an out-of-sample test. In addition, substantial value was added when the investors switched between domestic cash, bonds, and equity investments, i.e., your asset allocation. In a persistent high volatility market, the model told the investors to switch primarily to cash. Large market time benefits are possible because high volatility regimes tend to coincide with periods of relatively high interest rates and, in other words, put your cash to work at a high interest rate, right? And the fact that everything tends to move down. So interesting things about asset allocation, at least in my book. So what's my strategy tip for you? Look at it from the top down book. The look is what they call that, the 35,000 level first, to figure out what you think is really going on with the economy and so forth, and then work your way down from there. Don't forget, send emails, Dr. Frank's Finance World at jbawealth.com, and suggestions. You can also send Ask Dr. Frank. I'm going to build those up for a while and then see what people wanted to know most after looking through these. And Market Efficiency Part 2 is next. Appreciate you. Have a nice day. We'll catch you later. Bye-bye.